Hello, and welcome to today's session. Let's jump right in and get after it today. Market conditions. We'll start out with current market conditions as far as the long-term signal. We know where that's at. We know that we're sitting at the upper end of this range. We've started to pull back here on the momentum rank. This is the one-year trend momentum rank. Also corresponds to this number right here, bull market rank of 24.96. So essentially that's just telling us the magnitude of the trend, and obviously 0 is the cutoff point right here between bullish trend and bearish trend. Significant bull markets and bear markets, the longer term trend versus some of the shorter term trends that we focus on here as well. And so we've been up at this upper range, which creates more of a probability issue. The probability issue is, what are the probabilities that we can continue to extend this rally as extreme as it is to the upside? Okay, so that's why part of the reason when we're talking about allocation, we're talking about percentage allocation into equities, is where are we at in the trend? Are we early in the trend? Are we late in the trend, or are we somewhere in the middle of that trend? Okay, we obviously can see where we're at in relation to other trends. Okay, and this is the S&P 500 in relation to other trends in the past 20 years. We get these longer term trends, and then we get a pullback or a counter trend or a correction or a consolidation. Sometimes those are full bear markets. It's all nomenclature. It's all just sayings essentially, but it's really, is the market moving higher? Is it moving lower? And is it at what magnitude? Is it a shorter term correction, or is it a deeper, longer term correction? We haven't really had, even COVID was so fast. It really wasn't a bear market. It was just a correction. It was a fear-based correction, and then we had the Fed pump all that money in, so it just didn't last very long. This one lasted a little bit longer, more like 18 months. That was a little bit more traditional retracement counter trend, and pardon me, and this one right here is kind of still yet to be seen. We know where we've been, and the question now is, where are we going to be going from here, and how do we manage that? How do we allocate towards that? The thing that we don't want to do is we don't want to have kind of this pie in the sky idea that, yay, so we're going to buy stocks, and stocks always go higher, and we're going to make money on stocks. That's just not a prudent way to go about it. It certainly happens. We certainly get good opportunities there in terms of being able to increase and grow our capital. We only have a few choices essentially of where we can put our money to try and get that money to grow. We can put it in cash, we can put it in bonds, we can put it in futures, we can put it in forex, we can put it in crypto, we can put it in real estate, we can put it in art, we can put it in precious metals, we can put it in, there's lots of different places that we can put money, and there's lots of different things that go along with that. What's the liquidity? We're trying to sell a house. That's going to take a little bit of time to get the liquidity, get the cash out of that, versus stocks, ETFs, futures. Those are asset classes that are very liquid. They're very easy to be able to move money from one spot to another. They're liquid within seconds, instead of some other asset classes that may be a little bit longer time frame to liquidate. Even maybe a retirement account, a 401k IRA with your employer. Those are still easy to move money from cash to bonds, to equities, to whatever those allocations are. And so that really is the game that we've got to try and play in terms of how do we grow our capital and increase our wealth and protect it as well in a prudent manner, that we're not taking unnecessary risk, or we're not taking risk that we don't understand as well. Anytime we're dealing with a volatile type of market-based asset class, like a stock, like an ETF, there's always risk of loss. And so that, just knowing that we're trying to get a risk to reward type of relationship, then we've got to be able to do that in a way that says, what the heck am I doing? How do I allocate? Should I be in all stocks? Should I be in no stocks? Those are different suitability type questions that have to do with how can we manage risk, the time frame that we're dealing with. Okay, in most cases, the time frame to utilize our cash is important. If I don't need my money for 10 years, I can take a little bit more risk with volatility and allow for some drawdown, allow for some fluctuation, because I can more than likely recover those losses. If I need the money next week, if I need the money this year and I'm spending that money, then I want to take a little bit different approach to be able to do that. Maybe I don't have quite as much in volatile assets. Maybe I have a little bit more or a lot more in cash, things that are not moving quite as aggressively. We'll talk about that a little bit more as well, but it's a very important factor when we're talking about this big picture. When we're talking about what's the big picture, it also has to do with how are we allocated towards equities, because we're not going to be able to fight the market. We don't want to fight the market. We don't want to try and outsmart the market either, because we're not going to be able to do that. The market is the market. We just need to be trading with that overall market direction. If it's moving higher, we want to participate to the upside. If it's moving lower, we either want to be out or we want to have our allocations very, very small. For the most part, that's the core strategy. From there, we can certainly say, well, if it's moving down, maybe I want to hedge. Maybe I want something that will go up when the market goes down, like an inverse ETF or like a put option or something like that. Certainly ways to be able to do that as well. We're not quite there yet to be able to be looking aggressively to any downside, but where we are is we're at a hedging or a allocation location. And for me and this portfolio, for the most part that I'm managing, we're looking at still right around that 25 to 35% allocation, the bulk of it in cash. And because why not? Okay, we don't have to try and force it aggressively. Market conditions still, we also know economically, we'll talk about this again, this bond yield curve, we know that has to correct. If I go back and we look at, here's a market top, here's the bond yield curve. As the market retraces, we get a healthy bond yield curve. We get a market bottom. As it's rallying up, bonds start to adjust. The economy starts to heat up, or we get inflation, or we get, there's lots of different reasons why this happens. But for the most part, we talked about it quite a bit on Tuesday, so I won't rehash that too much here, but it is important to recognize now during this entire uptrend, you can see part of the reason why we had such an amazing stock market moving higher was because there was really no other location to put money, and money was easy. Remember, when money is easy, it's going to flow into typically into businesses, or it's typically going to flow into the stock market. Once money becomes tighter and interest rates get higher, the risk to reward is not as good. Okay, so we're at a location right now where if the stock market, if we can get on average 10, 12, 15, maybe on the upside, a really good year, 25 to 35% return, then that's fantastic, and that's what we're shooting for. But on average, if we're 10 to 12% or even lower than that annually, and we can get 5% in cash right now for doing nothing and just sitting there, then that's compelling. Okay, and so that's certainly a place to be considering as we're at these upper levels. And maybe not everything. You certainly could say, okay, I'm going to sit this out a little bit with the bulk of cash, with the bulk in cash, so that I am not taking additional risk. It's more about the risk of volatility in those allocations. Now, in the shorter term, we want to try and make smart decisions based on where the current market conditions are at, what they're giving us, what opportunities are there versus just forcing anything for any reason. Just because today is a new day doesn't necessarily mean I have to do something just because I can, right? Just because I can go in and click my buy button in my brokerage account doesn't mean that I need to, or that I should be doing anything at all. But there's always opportunities. There's opportunities every day, and we want to try and capture that the best that we can. Now, let's talk about this short-term market condition. We've had this big run-up. We've had our rally here. It's just been really surprisingly strong, honestly, and that's the fascinating thing about the stock market is it's never the same. It's very similar. It rhymes. History doesn't repeat itself, but it rhymes. The stock market is the same way. It very seldom repeats itself, but it's very similar in its behavior. A lot of times there's just different players. We're dealing with different stocks. We're dealing with different leadership. We're dealing with different economic conditions. We're dealing with different worldwide geopolitical, or an election year, or this or that. It's always evolving. It's always changing. That keeps it fresh. That keeps it interesting. But for the most part, the characteristics are similar, and that is we're going to get an uptrend, we're going to get a retracement, we're going to ultimately get a bigger retracement and then a bear market, and then it's going to create more demand, valuations kind of get reset, and then we get a new opportunity for buying back in again. Then you get more demand, then you get supply at the top. It's just these things happen over and over again. So what we're trying to do each day is focus on where are we at in that cycle. Okay, so right now we know that momentum, we know that we're in this long-term uptrend, we know that we're at the top end of this long-term uptrend. In the short term, we know that we've had this retracement, we've now had this run up potentially to this top. Now, some of the characteristics of the rally we also want to be aware of. Did this rally happen? Did it pull momentum higher? Yes, it did. It pulled it back to that uptrend. Did it pull breadth higher? Yes, it did. We're back now in this uptrend. 74, that means that 74% of stocks in the S&P 500, at least on this example, are in uptrends. We've got a little bit longer term or more stocks in the buy-sell ratio, so not quite as many, but we're bullish. Okay, we've got a buy-sell ratio of 1.6. So we're getting more, a little bit more heavily weighted towards that buy side. Okay, that's bullish. That's a bullish condition, even though we're having a bit of a retracement. Now, this is always the interesting part of these trends, and that is, oh boy, okay, here it comes. Here comes the retracement. Okay, what's going to happen right here? Is it going to blow back all the way down? Is it going to retrace back down to support? Is it going to stop right here? Is it going to move higher? Is it, we just don't know what's going to happen from here. But what we do have is we do now have this information. This is a price trend that was really quick. It was really strong. It was right in the middle of the summer as well. So volume was not very high. Volume actually was kind of declining through most of those trends, versus if you look at volume back here versus these last few days of volume, it's relatively light, and that's could be some summer volume that when we start to get a retracement, even if we get some economic news that the two things that could really scare the market are the inflation number. If we see inflation numbers that are stagnant or going back up again, or if we start to see economic numbers, recessionary numbers, corporate numbers in their earnings, GDP numbers that are weakening. So far, we haven't seen that, at least in the last couple of weeks. Data so far for this week, I think there's some FOMC minutes. That might even be today, and that might be why the market's kind of pulling back. I haven't looked, and that is kind of where we're at right here. Quick question. Let me just pull in this question. When I was learning, here's a question. When I was learning candlesticks, they talked about ABC patterns. Does that method still have merit? Two different topics, really. Candlesticks and ABC patterns are not the same thing. Candlesticks are really just the way that you're looking at the chart pattern. A candlestick is this perspective, and that is where it has a fat body, and then it has a wick, versus just a bar chart, which is just a line. Okay, you're going to get an open, a high, a low, and a close, something like this. Versus a candlestick, which is this. You get a body which gives a little bit, all it is just a representation of what the price data is doing. It's a little bit more visual. Okay, that's the candlestick, and that's what I prefer to use, and that's what TradersPro software uses, is a candlestick perspective, just because things like a bottoming tail bar like that, we want to see what's the story that tells. It tells us that it opened, it retraced lower, and then it rallied. Okay, that tells us the story of the market action. That's all it's telling us, is we're getting market activity when the candlestick is showing us. In fact, if I were to change this perspective over to candlesticks, oops, not that one, I want this one, then we could see at the bottom of this pattern right here, you're getting a bullish candlestick. Now, the candlestick is number one. The ABC pattern is another name for, in Elliott wave or in any retracement type pattern, a three-part counter trend is referred to as an ABC pattern. So if I have a trending move that's moving this direction, okay, and let's say that it's just this pattern right here, and then I get a retracement, okay, and it looks like this, okay, that's referred to as an ABC pattern, A, B, C. It's just a three-part counter trend, okay, so you could say A, B, C. Okay, you could say A, B, C. It's just that three part. You get the first part, you You get the first sell-off, the second one, and the third one. And that gives us a secondary retest. And then the candlesticks can become important. So in terms of the ABC pattern, they're absolutely valid, but they're nothing more than just a representation of a counter trend retracement. And it works on the bearish side as well. If this is a downtrend and I have A, B, C, it's a three-part counter trend. The trend direction is this way. The ABC pattern is the counter trend. So if the trend is up and you get a three-part counter trend, then that's the ABC. Okay, ABC, and they absolutely have merit because think about the psychology. Remember, the most important part of the price data is the psychology behind the price data, as well as what the price data is doing. Okay, and so the price data is telling us what happens on an ABC pattern, and this actually could also be considered a deep ABC pattern. If I pull that up and I pull that out to maybe a 1-year time frame, this counter trend pattern, you get this move here, A, B. B is also oftentimes referred to as a sucker's rally, okay? Because what happens on a B wave is you get support, that first sell-off, and then you get buying, and you get people sucked in to that rally, okay? And sometimes it's valid that the trend that may not be over. It's continuing higher. So it's typically worth taking a trade into that, and you don't know that it's a C wave until it slices through that. And C waves are typically impulsive waves, meaning they happen fast, they happen aggressive. It's throwing out the baby in the bathwater. It's just selling for the sake of selling. But what happens at the completion of an ABC pattern is, again, the psychology of supply demand. There's nobody left to sell. What's going to happen when there's nobody left to sell? You get buyers that start to step back in. Okay, then you get buying activity. So the real advantage of understanding an ABC pattern is where the supply demand is happening. Okay, and in this case, you have a completion of an ABC pattern support, and then you could also use a candlestick and say, all right, what kind of a candlestick do I have? I've got an ABC pattern that's potentially completing, and then we also use these zones. These Fibonacci zones are saying, here's my high, here's my low, here's my retracement zones. Momentum, it typically stays in the 236 zone. Correction or counter trend, it can dip all the way down into these locations and still be an uptrend. S&P 500 on the 1 year got to that 382 and then really rallied. There was also some support kind of across the board here as well. So it was a natural location to at least see a bounce starting to happen. And then you did have a couple of bullish candlesticks that were starting to happen inside of here as well. Hopefully that makes sense. So there are two different things. The candlesticks tell you one thing, the ABC tells you another thing. It's just a part of the trend formation, and the exactness of those, I've spent years focusing on the exactness of the ABC pattern, that the A leg has to be equal to the C leg, and there are a lot of those are typically referred to as Elliott wave. It's rules within Elliott wave. Elliott wave is a fascinating study because what it does is it basically says that the underlying trends of market movement are based on human nature, and human nature we deal in fear and greed, and so far in our evolution we can't get that out of our brains. Okay, we are a greedy creature, we are a fearful creature, and when we're dealing with money, those two things create the maximum greed and the maximum fear, and so the price patterns unfold in a way that start to show greed and fear. Okay, the fear, when you get these panic sells or you get just a massive sell-off, you're going to get traders that are also involved in that, but most of the time it's fear. And so you get an area now where there's nobody left to sell, and if there is demand, it's going to show up at the bottom of a C wave, so a completion. So that can be an area, if you got the stomach to be able to step in and buy at these locations, that's a great early entry, okay, to be able to get into the completion of an ABC pattern. So yeah, so hopefully that answers the question. They are very valid, and they are really really helpful because visually you'll start to see them happening. Even if if you just look at this pattern, ABC, ABC, this is a little bit longer ABC pattern, ABC, ABC, they're counter trends, they're corrective patterns. Okay, and the way that we are primarily focusing on those is, I don't talk about them much, but they're still relevant, because even if they're in a counter trend move, let's see if we can find any kind of an example. This was an interesting example right here, where you have this sideways stair-stepping pattern. Let me come over here just a little bit. So let's say that we were connected to this high right here, okay, and we get a price pattern that's up in the momentum zone, and we've had a new high and it's consolidated. We've now had one touch, two touches. Okay, so now if I'm looking at this chart and I'm in the momentum zone, I would say here's A, B, C, or possible A, B, C. It's just a 2-part or 3-part counter trend. A lot of times it's referred to as, that's why there's so many names for all of these patterns: flags and pennants, wedges, everything head and shoulders. It's because it's all the same thing. It's just everybody's trying to put their own explanation on what the heck is this thing. Well, it looks like a head and shoulder. Well, it looks like a flag. Well, it looks like a wedge. Well, it looks like it's just price action. Okay, and price action happens inside of zones. And when you get a support zone at the bottom of a range, you're going to get buyers, okay? Because what's happening, that's the demand zone. The supply zone is here. Somebody bought here, they're trading, they're selling here. They're coming back, you get a support zone. Eventually that breaks out and we get momentum. And that's ultimately what we want, is we want the momentum part of those trends, okay? And so we just are not as focused on what does that counter trend look like versus understanding it's going to retest. We just don't want to see it slide any deeper because we want to keep that momentum. That makes sense. So you can visually see some counter trend patterns. You don't always get an ABC pattern like this. Here it's a correction, it's a counter zone, it's a counter trend, it's a pause. Think of a runner, think of a sprinter. Okay, it's got a sprint and then it's got to rest for a minute. I got to have a rest. I've got to sprint and then I've got to rest. What's the rest? The rest is there's nobody left to buy. The buying demand is gone, okay, at least for a short amount of time. And then it picks back up and then it pauses and then the demand comes back in. That's ultimately what we want to find in a trending or a momentum style stock. Is we want to find high ranking stocks. Why? Okay, because they're already in an uptrend and there's already demand and they're already working for us in the right direction. What's the right direction? The right direction is up. What's the wrong direction? The wrong direction is if it's down, moving down and losing money. We don't want to try and say, oh, it's moving lower, let's buy here. It's moving lower, let's buy here. It's moving lower, let's buy here. We can. I'm not saying we can't do that, but I'm saying the methodology for momentum is let's try and trade into this as long as it works. At some point, it's going to stop working. Well, what do? We move along. We move to the next stock that is a leading stock. We go in, and there's always going to be something in here that's working a little bit different than the last round of stocks. Crocs, for example, let's see if I can go back far enough. This stock's been all over the place in terms of, some of its uptrends and downtrends. But when it has these real big run-ups, that's a great stock to trade. During these nasty downturns, even here, it's like we might be able to catch the move here and here. This is what we're focused on, the primary focus. And when I go out to that 2-year time frame, it looks very clean. It looks very clear. It's like, oh, that's obvious. Okay, that's obvious that I should be trading this and then be paying and then trailing my stop loss. But what's harder to do is saying, what should I do now? What should I do today? That's why we go into a little bit shorter time frame and say, that's not quite in the momentum zone yet. It's a time frame is down, even though it's strong. I may not want to trade that. It's not quite yet, because this may be telling me that this shorter term downtrend, it may run into resistance and I may get some more downside. It's just a filtering mechanism to be able to say, I want to be able to focus on the ones. This is APLT is actually an interesting example as well, because this is another one that was really traded back this last year, moved higher, retraced back down, and it's kind of working its way back up. But there have been other stocks along the way in those overall uptrends. Okay, good question, because all methodologies are simply just trying to analyze the price data. That's the only thing there is to analyze. Even fundamental traders are looking at the fundamental data of the stock, and then they have to decide, do I think that this is worth buying or not? Okay, you get a stock like this, PRCT, which has had this big uptrend, big gap moving higher. Okay, the fundamentals may or may not be compelling to a fundamental trader. They may feel like, this thing is overvalued. It's never going to go higher. Blah blah blah. You know, whatever story that it's, we all come up with stories of why we think things are going higher or lower. I don't know. I don't have a story, because all I want to do is I want to do what everyone else is doing at right now, and that is the stock is moving higher for whatever reason. Let's participate in that while it's working. At some point, it's not going to work, and I may have every idea in the world. I see on YouTube all the time. Let's see. Shoot, what is the PayPal? So PayPal, for the last couple of years, everyone's talking about PayPal. Is PayPal going to bottom? Is it 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 going to bottom? Well, what a waste of time. Okay, what a waste of time to try and figure out if a piece of crap company is going to go higher. Okay, the stock price will tell you if there's any value in it, because the traders, big institutions, are going to be buying it up. Okay, so in this case, all you did is just pounded your head against the wall for a year trying to get a piece of crap stock to go higher. There's no point in that. So only because everyone's like, well, everyone uses PayPal. Well, so what? That doesn't matter. That obviously the market does not agree. Right now, it's starting to get some price activity. And if I were a really, really long-term investor, a Warren Buffett type investor, then yeah, maybe I am buying down here, really, really deep value type of style. But in terms of a momentum strategy, it just is not a good qualifier, at least as of yet. It may be, and it may be in the shorter term actually now that it's got 6-month time frame, momentum zone, give it a pullback. Now we've got some structure, right? Now we've got some structure that we can work with. This is our structure for the most part. 6-month time frame, momentum zone. Here's our location. We can now be watching for any kind of pullbacks, confirmation bars, increasing volume. Now it maybe is of interest. It's gaining some momentum as far as strength as well. Okay, so but we still want to apply it to the structure that we're utilizing, so that we're not saying why isn't this going higher because everybody uses PayPal or they're making a lot of money, or fill in the blank of why it should go higher. Nobody knows why stocks are going to go higher. Even big institutions are going to make bad decisions. That's why they're so diversified. That's why they have 1,000 holdings for the most part. And that's even in momentum style, we don't know which one is going to be the ASTS up 162. Okay, there's no way to know that. Yeah, it's a cool idea, and yeah, it's a cool technology, but they don't even have a satellite in the sky yet. Okay, so it's like they're very early. It's a wireless satellite cellular company, and they're still just getting started. So, but there's a huge amount of demand for this stock right now, based on the future, based on what they might do, or based on what they could do, or obviously based on what they are doing. But anybody that said, well, these guys are XYZ and blah 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 and this and that, and said it's never going to go higher than 10. Well, now it's at 30, and we're missing out. We don't want to be that. We want to participate as long as we possibly can, and that obviously there's risk in that, because these stocks can come down just as fast as they go up. So we want to make sure that we're setting up our stop losses. We're trailing those stop losses as they're going higher, and focusing on a structure to be able to add into some of those trades. So a couple other ideas here. Let's actually look at, this is an interesting stock, RBLX, Roblox. This is another good example of what we would want to try and see, and that is on the 6-month time frame, you've had a correction, you've had that pullback, but now here it is. And again, remember that when it comes to this buying, it's really hard to do for whatever reason, but it's hard to just get rid of this out of our minds, okay, and say, here is what we're dealing with. This is today. This is right now. This is the exact moment that we're dealing with, and focusing on, where do I think it could go from here? Well, the price momentum is telling me that it's moving higher. Will it continue to go higher? I don't know. but it's in the location that you're starting to see the demand come back in, and that's the kind of setup that we would want to be able to take advantage of. Really nice confirmation bar. From here, we would go in and say, okay, if I were to have wanted, if I saw this morning, I wanted to buy it this morning, I've got to go in and I've got to set up my risk profile. Got to see how many shares. It's a $40 stock. Let's see what 50 shares. 50 shares puts me at 2%. Okay, let's say 45 shares, 1.8. Let's stick with that 50 shares, 2%. That's right, very close already. So I know that I'm dealing with 50 shares. Now I want to know what's my risk to the downside. I could probably set a stop right below that. Okay, meaning that if it were to retrace and come all the way back down below this low point, and I said, I'm only willing to hold this stock until or as long as it goes higher. If it retraces back to a certain point, I'm not willing to hold on to it any longer. That's your stop loss location. Let's call it $40 here and say there's 40, that's 0.192. So if I were to have wanted to buy this stock this morning and a stop that's an 8% stop, that's still reasonable. At 40, I'm in this trade $193, and that's it. Okay, now it's either going to go up or it's going to go down. I don't have any control from here. I can't do anything. I can't, I can't, I can wish, I can hope, I can root, I can panic, I can freak out, I can, I can think about it every second. There's a lot of things that I can do, but I have absolutely zero control from here on what the stock does. It can go up, it can go down. Whether or not, and that's why I'm always interested in, like, everyone that's like, I picked this and I picked that. It's like, well, it's just, so what? Everybody picks stocks every day. They go up and they go down. It's just about finding one that's fitting inside of your methodology. It's one that's fitting inside of your risk profile structure. And then it's taking a trade. And it's also being in the right market conditions. Right now, we're in good market conditions. Okay, so stocks are going to continue to work. When the markets start to retrace, then, all bets are kind of off. We get stopped out of things. Trades are not breaking out. They're not moving higher. So market conditions are good. How do we know market conditions are good or moving higher? Because the buy-sell ratio is positive. That means the bulk of the market stocks are moving higher. We've also moved back up into momentum. We also have breadth. Okay, so those would say, market conditions. What are market conditions? Well, they're moving higher. We're at the upper end of this range. How do I manage that? I should be able to buy into some stocks right here, good quality momentum stocks that have a buy confirmation bar, set my risk, and then go golf, go play with the grandkids, go do whatever. We can't, once we're in those trades, then we're in the trades, and we make sure we have those stop losses for the moments that things come unglued, and they do, and just making sure we're protected on that. Hopefully all of that made sense. It was like kind of jumping around a little bit, but it's essentially the same process that we're focusing on. There's there's variations of that, but for the core methodology that is really focused on buying stocks that are going higher based on ideas that are super cool, and technologies that are taking off. For example, this stock today. So we did buy into this stock today in the wheel portfolio. But one of the other things too is if you go out to Google and then go down to their website right here and say, what are these guys doing? Well, these guys are creating next generation AI powered robotic platforms for hospitals, for ultrasounds and different things like that. I'm fascinated by that. I love the brilliance of companies, and some of these amazing companies and people that are out there inventing really cool things and doing really cool things in our world. And how can we participate on that? And are there ways and opportunities to be able to understand that a little bit more? There are, but first of all, we got to see what is the price pattern doing. And then we can look and say, this is pretty fascinating. Yeah, maybe I'll go ahead and jump into this one because that really looks like a promising, interesting technology. An interesting technology doesn't always equate to a good stock, but it is like that's an area of the world and the economy and healthcare that AI is really, the whole diagnostic thing is really going to be helpful in a lot of the diagnostic, these equipment, these technologies that are being created. And that's the fun part. That's really the fun, fascinating part of buying stocks and looking for stocks that are continuing to move higher in momentum, because that's ultimately what we want. And we're going to have moments where we catch a trend and we're in that trend. Let's say that let's go out to this 1 year time frame. And let's say that, this stock came up on our radar back here. And maybe we were buying into that somewhere back here. We bought in and it pulls back and we go a day or two. What happens? Okay, there's a nice confirmation bar. It's moving higher. There it goes. It starts to break higher. Now look what's happening to our 236. Okay, that 236, we may have been stopped out here, but we can be like, oh, okay, it's now giving us some hesitation. It's kind of getting flaky right here. It's pausing, it's resting. It could retrace. Is it inside of my risk profile? I've adjusted my stop. Maybe I haven't been stopped out. Maybe I have at this point, but now it's like, here's a new confirmation. Now we're moving higher. Now we're watching it again. It's continuing to move higher. At some point, it's going to stop moving higher and it's going to start moving lower. Now, here's a stop out, here's a retracement. Now we're at the point where it's like, okay, this is a cool company. I like the technology, but the price pattern is now in a downtrend. I don't want to wait and see when it recovers, if it recovers, because it might give back everything. And it might give back more than everything. And it might give it all back on a day or two. And once we turn those trends to the downside, then we're adding some additional risk. Now, here again, it's a good company, retracement pulling higher. Now back up to this momentum. Now we can say, oh, there's green again. Now we're back above the 236. Now we can start to play again. Buy here, set our stop here. How much higher is it going to go from here? I don't know, but will it go higher? Certainly could, or not. So that in this case, maybe stopped out. That's a whipsaw. Okay, now back again. Here's a big move. We take a trade on it again. Sure, let's take a trade on that and see if we can get some momentum to the upside. It's essentially that process. What we're not looking for is something that had a massive downturn and then it's like, oh, I think it's going to bottom out. Or buy, wait forever. Maybe it recovers, maybe it moves higher. Now we're 3 years into this thing, and we're either not making money or we're flat or we're losing money. It's that the entire system is based on let's look for these stocks, these muscle stocks that are moving higher. These are great places to start and look. FTI is a great example. This thing it just won't quit. Okay, it's just, and even here we had a pretty nasty pullback, lots of selling. It's moving higher and continue to move higher. Good session. I appreciate your time and effort. Went a little bit longer because I slacked off on you last Thursday, and I apologize for that. So I appreciate everyone's time and effort, and we will see you on Tuesday. Have a great weekend. Thanks a lot. Bye now.